Okay, if you're looking for more opportunities to sell life insurance, the best leads that we see at LWT come from marketing to business owners. The fact is that successful business owners, they make money and they have money to spend on improving their financial security. Hi, my name is Dave Donchie with Leisure, Worden and Terry, and thanks for joining us today. Also joining me are my associates Victor Paz, Jim Howard, and Mike Testa. Hi, guys.
Hello, everyone.
So today we're going to share with you key ideas on retirement planning for business owners and their key employees. And you can get in front of more business owners and open up some nice cases with the strategies we're going to share with you today. Our special guest today is Dan Hardy from Principal Financial. Dan's been in the financial industry, services industry since 2009, and he's got a bachelor's degree in marketing from Iowa State University and an MBA from the University of Iowa. Dan also holds his CLU and CHFC designations, which tells me how committed he is to his craft. That's real impressive. Dan is a regional vice president in the life business solutions area of Principal Financial, and he focuses on the design and point of sale support for business sponsored life insurance plans, business exit strategies, and key person retention strategies. By the way, Dan is also an Ironman triathlon competitor, which is another very impressive trait, Dan. So welcome, Dan. Thanks a lot for joining us. And why don't we talk about life insurance opportunities that producers can uncover in the business market?
Absolutely. Thanks for having me, Dave. Really appreciate the opportunity to join everyone on today's call. As you mentioned, life insurance, our sales here in the business space, specifically around non-qualified plans and key employee retention. We had a record year last year, 2018, with those types of solutions. And more importantly, I'd say that even into this year, we're having a strong year, and these types of solutions are top of mind for business owners. Earlier today, I was actually with a couple of business owners that are in town here in Des Moines, Iowa, for the Principal Charity Classic. And I was talking to them, and the first thing they wanted to talk about was how they can retain their key employees. So it's something that's critical, and it's definitely on the minds of your business owner clients. So I would urge you to reach out to those owners and work with them to put a plan and a strategy in place to retain their top talent. So today's call, we're going to focus on non-qualified plans, and we're going to view these plans through both the lens of the employer and the lens of the employee. If we move along to the next slide, it's titled The Retirement Gap. So just a very high-level overview of non-qualified plans. These plans can be built to not only, as we've talked about, retain key employees, but also provide for supplemental retirement income savings in a number of different capacities for owners and for key employees. So that you can structure these in a number of different ways, and it does meet a number of different needs, both for retention and for meeting that gap that you see on the screen, where as income grows, the gap between retirement benefits, qualified plans, and Social Security benefits becomes quite substantial just due to those high incomes and the amount that those high income earners can save into those qualified plans. So from a retention standpoint, non-qualified solutions can first and foremost be put in place for selected employees only, and the retention component is structured through a vesting schedule, which you can get quite customized. Another thing that I think is telling, there was an article actually in the USA Today on Friday about employees are more apt to go work for employers that are offering a student loan repayment plan. So non-qualified plans can actually be built around bonuses provided to employees to pay off student loans or to repay them for paying off their student loans. So it's designing a solution that is really beneficial based on the philosophy and the goals of that employee if you're trying to retain them. We also see non-qualified plans being built into buying into a company as well.
This is Victor. That's a great point, Dan, and that's an interesting article that you mentioned because it got me to thinking that we are talking about retaining key employees, but this is also a great strategy when an employer is trying to attract the best employees. When you're interviewing an employer, and employer's interviewing a potential employee, it could work well in that space also.
Yeah, the biggest advocates for non-qualified plans at employers are employees that have joined that employer that doesn't have a non-qualified plan and had one previously at a former employer. As we move into the designing of a non-qualified plan on the next slide, there are three key questions as we start that design discussion and consultation. First and foremost, knowing the entity type. Non-qualified plans are really customized based on if it's a flow-through business like the S Corp or LLCs, a C corporation, or a tax-exempt entity. So knowing the entity type and the structure to determine which plans are available is an incredibly important first question to ask. The next question is, who is in the plan? Is the plan a non-qualified plan designed for employees or for the owner, him or herself? And then lastly, the goals of the plan. Are they more focused on supplemental retirement income savings, or are they more focused on the retention components that non-qualified plans can offer? We can design plans to meet both of those needs, and again, for all of those persons that I mentioned. If we move into the first plan design here to discuss today, this is your most traditional deferred compensation plan. You'll hear these called 401k mirror plans, 409A plans, probably in the truest sense, just deferred compensation. So this is the principal excess plan. It is a 401k mirror plan in which you would look at selected employees and provide them with the ability to defer income over and above the amounts that they're able to defer into their 401k plans because of those qualified plan limitations. It can be incentive-based if there's an employer contribution going into the plan, and that's where the hook is going to be in the employee with those employer contributions. Now, this type of plan is available to what the IRS qualifies as a top hat employee. So it's selected key employees. It's not for the entire employee workforce. So a top hat employee, in a guideline for that is going to be $120,000 of compensation and above, or the top 10% compensation-wise in an organization. Again, it allows them to have a plan that's very similar to a qualified plan in which they defer income to a future date in this type of plan. If we move into now the lens of looking at deferred comp from the organization standpoint, the benefits here is key employees recognize this is a very valuable benefit. And they are selected and given potentially an employer contribution as well. So it helps the organization recruit, as Victor mentioned, reward and retain key employees. Now with this plan, an employee says, I'm going to defer an additional $25,000 of my income, and that money then stays with the organization. It is taxable income to the organization, but tax deferred to the employees. So that's an important piece. So deferred income tax deduction because of the current taxable income that the employer is going to be seeing. Now, anytime you're promising to pay an employee, whether it be because of a deferral or an employer contribution in the future, you establish a liability on the balance sheet. And so if I have my CFO hat on, the most important item for me is, well, I want to offset that liability, especially a large liability. If I have large deferrals or a lot of participants in a plan, I want to offset that by purchasing a financial vehicle in order to have an asset that's roughly equivalent to that liability on the balance sheet. One of the most effective and efficient ways to offset that and have a cash equivalent on the balance sheet is through the use of a cash value life insurance policy. If you use some of the other assets, such as mutual funds or just keeping cash on the balance sheet, you do have some potential earnings charges on those assets. Another consideration in a deferred comp plan is there may be some administrative costs. And so the way I like to think about this is the greater the complexity of the design with vesting of employer contributions and elective deferrals, the more complexity you have there, the more expensive the plan may be. The less complex and the more straightforward plans typically will have lower expenses. So customization is absolutely something you can do, and we have a lot of guidelines as to what type of customization we're seeing employers utilizing. But it is important to keep in mind that there may be those administrative service fees as the plan grows in complexity. If we move on now from the lens of the employee, if I'm an employee, I'm really happy about this plan because it allows me to accumulate additional retirement income on a tax-deferred basis, just as I'm doing in my 401k plan. That's the biggest takeaway for benefits on deferred compensation. From a consideration standpoint, there is a substantial risk of forfeiture with that plan. So there's a limited ERISA protection. If the employer potentially goes under, I'm in line as an employee with all the other creditors of the business in order to receive my retirement benefit in that deferred compensation plan. So employees should really be very trusting of the company, should have a long established history in the company that the company should have, and a good management staff. Sometimes employees say, you know what, I'm fairly certain this plan is going to be good. I think the company's on the right track, but I don't want the company to set aside assets to finance this plan, but then end up using them for something more frivolous. So in that case, we can utilize something that's called a rabbi trust, which is essentially just moving money from the company balance sheet into that trust, and making it unavailable for the owners of the company or the management of the company to use for other options. It is very much specifically used for the funding and financing of that deferred comp plan. Still subject to creditor risk, but you don't have that mismanagement risk, if you will. Anything, Victor or Dave, that you want to just tack on to that on the deferred comp in its truest sense?
Oh, Principal does some of this administration for these types of plans, correct?
Absolutely. We are the largest non-qualified plan administrator in the country.
So the producer doesn't have to worry about trying to go out and find third-party administration services when you folks can do it in-house.
Yeah, I like to say we're one throat to choke or one back to pat, in that we provide the product to help with the financing, the design and the consultation, as well as the administration thereafter. So it's not the life carrier pointing to the administrator who's pointing to the agent or the advisor. It's one team that's comprehensively here built to meet the needs and goals and objectives of the client.
Good. That's good. That's efficient. All right. Thank you.
And so the only other comment I have, if I may, Dan, is that we're in this case we're probably going to be using or looking at Principal's IUL product. Is that correct? Typically.
Yeah, that's a product that we're seeing used for a lot of these non-qualified plans. We also have a number of other product options.
Okay.
So as we move into the Select Reward plan, this is one of our simplified deferred comp plans. And the slide here, how it works is during the service period. I think this is a good piece. So we see these plans with an annual premium or contribution of $10,000 to $150,000 per year. And the service period is established at the outset. So the employee agrees that if I work for LWT for the next 15 years or 10 years, I get a lump sum bonus at the end of that 15-year period. If I leave at any point in time before that 15-year period, I sacrifice that benefit, and the company keeps the asset that's funding that plan, again, typically by way of a life insurance policy. So it retains that key employee by a promised future lump sum. Now, I like that 10 to 15-year window with this plan, because if you have employers that say, I want to do this for 20 or 30 years, that's a long horizon for an employee to think about, versus 10 to 15 years is a more manageable horizon. So if they want that longer term retention, we do have some options for them. Now, once they fulfill that service period, again, you can structure it so that it's a bonus that's to be used to buy into the business, to repay student loan debt, those types of plans. So it's customized based on what is psychologically the biggest benefit for that employee. So if you look to the payout period on the next slide, after that policy, after that individual meets that 15-year period, the policy is typically rolled out to the executive. During the service period, there's some key person protection because it's a life insurance policy that's corporately owned. You can split the death benefit through an endorsement split dollar contract if you'd like to provide some executive death benefit. But typically, once the policy or once that employee meets that 15-year service period, the policy is given to them to fulfill that lump sum promise. So now they've got a policy that they could surrender and take all the cash out of. It is taxable income to them at the rollout, obviously, and tax deductible to the business. But they have that as an option. They could take all the money out. They could keep the death benefit in place if that's more important to them. They could minimize the death benefit and allow that policy to grow tax deferred and then draw on that as an income stream in retirement. It's a plan that provides for a life policy, which employees are commonly saying is better than just a lump sum cash bonus. As we move into the next plan design, the problem, if you will, with the last plan, the select reward plan that we talked about, the only problem is I'm getting a lot of money in 1 year. Now, some people are probably laughing, saying that's not necessarily a problem, getting a bunch of money. But in states like California and some other high income tax states, those marginal rates can get you, for lack of a better term. So sometimes employees say, well, I don't want this $2 million bonus or $250,000 bonus or whatever that amount is. I'd rather have it over a period of years. And in that case, we can definitely do that. So we have a second plan, which is again a 409A deferred comp plan, which is called the CERT Select plan. It's very similar to the Select Reward plan that we just discussed. You do have the option of a lump sum payout, but typically we're seeing those payouts take place over a 10-year period. So rather than transferring the policy itself to the executive, the company retains that policy for cost recovery purposes, being one, but they use the cash values in that policy to pay the employee a specified amount each year for the next 10 years. We do have some longer vesting options and service periods in this plan, all the way up until retirement age if the company is looking for that. In this plan, we're seeing a lot with C-Corp owners too, because of that arbitrage between a 21% flat corporate rate and a 37% top marginal rate on the personal side. Let's move on into one of now the after-tax solutions. This is something we do. It's probably one of the most popular plan designs for non-qualified plans. All of the other ones we've talked about thus far, the life insurance policy and the financial tool is owned by the company. In this plan design, the employee at the outset is the owner of the life insurance policy. So that provides for a current deduction to the business, current taxable income to the executive, but usually the employer is grossing up for that current taxable income to the employee. So it's kind of a win-win for the employee. It's taxable today, yes, but the employer is paying it. It grows tax deferred and it's paid out to them tax-free. So you're probably thinking, well, that's a great benefit for them, but where's the golden handcuffs? And the golden handcuffs is accomplished by, again, a plan document, an agreement that the employee and the employer sign. It would state, if I leave as the employee before X number of years, and you can structure this as a rolling schedule, I have to pay back either the entirety of or a portion of the premium or the most recent premiums that have paid into that policy for me. So it makes that employee think twice before leaving the company.
Dan, this
I
is
would
Victor.
think that this has, I would think that this has the least amount, if no, administrative expenses to monitor because it's owned by the employee.
Yeah, so the only plan that we have that has administrative costs that we've talked about today is that first plan, the true traditional deferred compensation plan, the Select Reward plan, the CERT Select, and this executive bonus plan. We take care of all the administration for you on a complimentary basis.
So there would only be a cost to set up the agreement here, and that's it.
Yeah, the cost, the agreement, we provide the sample agreements, but the client's attorney is actually going to execute those agreements. So there may be some costs there, Dave. I think that's a good point. But from principal standpoint, it's whatever the premium is, that's technically the cost to the plan. We made a choice a number of years back, about 20 years ago, that we won't charge for the majority of our plan administration other than that highly customizable plan that we talked about at the outset. because we see these plans stay on the books longer, and we see these plans tend to grow. So they're more profitable to us as a carrier, and they're more profitable to advisors because plans continue to add employees to them.
Thank you. Victor, go ahead.
Mo, I think that Dan addressed. You have sample plan documents that we could share with our producers.
Absolutely.
That's perfect. That's what I was looking for. Thank you.
And discussions around those. A lot of times, the client is implementing one of the sample plans, and the attorney wants to make a customized change, and they say, "Hey, would you review this, or can we hop on a line to discuss maybe an option here?" And we absolutely will do that. Connect them with our attorneys to discuss that as well, and that's no charge from us. Just something we provide through LWT.
Mm-hmm. Thank you.
The next plan I'll just touch on because I think it's important. Most of the plans that we've discussed today, if you're looking at an S corp, would not be available for the owner. But one plan that would be available specifically for an owner of a flow-through business is this Owner NQ, this S Owner Plus plan. And the reason this is important to discuss today, it is there's a current deduction that's available for S corporations, which reduces their tax rates for the next 6 years, and then it sunsets unless Congress extends it. It's called the 199A deduction. And I won't go through all the nuances there, just give you a highlight. If the owner is married filing jointly, making $315,000 or less, they get a 20% deduction on their qualified business income or their K-1 distribution. Doesn't apply to their W-2 or their guaranteed payment if they're an LLC, but it does apply to that qualified business distribution. So it reduces their current rate today. So your lights should be going off saying, if I can pay lower taxes today than I will be in the future, I'd rather pay those lower taxes today, put it into a vehicle that grows tax deferred, and then I can access it tax-free. Now, the only vehicle that can do that for a lot of these higher income earners is going to be a life insurance policy. So we have a plan with specialized life insurance products with high early cash value as an example, and corporate or executive mortality that allows employers to do just that just for them. A life insurance policy, typically with K-1 distribution, that is post-tax, grows tax deferred, and they take it out tax-free. It is a nice thing to discuss, especially as that will sunset, as I mentioned, in 6 years. And we can really design an efficient contract to take 6 to 7 premium payments and minimize the cost of insurance. Mm-hmm. One of the last slides here is just a quick cheat sheet for you around the plans we've discussed today and the business considerations such as deductions and handcuffs and when taxation is going to occur. This is a cheat sheet for you. It highlights the 5 most popular plans that we have. Again, we have about 30 different types of plans, or almost 30 different types of plans. But these are really the building blocks for those discussions. So I'm not going to walk through each of these items today, but this is a good thing as you're discussing these plans with your business owner clients. You can answer which plans may be the best fit for them. And then lastly, we've talked about this. Dave and Victor did a great job of saying, talking about the administration that Principal can provide. We're here to help you, help your business owner clients through the design and consultation, the implementation of a product. Again, we partner with LWT to make sure it's the right product for the right client, for the right goals. And then lastly, with the administration taking place most oftentimes on a complementary basis, except for those more institutional deferred comp plans. So we appreciate the opportunity. We appreciate your business, and we really appreciate the partnership with LWT.
Well, we certainly do, Dan. And we thank you for taking the time to put this together. They're really good opportunities for our producers to open up conversations with the business owners that they know. Victor and I talk about this quite often, as do Jim and Mike. And all they really need to do is open the conversation, and we will step in with the support of you and Principal to provide that type of strength so that they can open up interesting and exciting cases that will be good for them and good for their clients. So on that note, we appreciate you for doing this, and thank you folks for listening. If you have any questions, please reach out, contact your favorite LWT sales associate. You can email us, you can call us, and we'll walk through a case that you might have and an opportunity that we can help you open. So thank you everybody for joining, and we'll talk with you soon.